Hello, I'm Rick Cross, Managing Director with American Portfolios out of the Holbrook, New York office. In a recent New York Times article, it pointed out that even with the market surge, the losses, stress, and turmoil of the last lost decade provide plenty of reasons to stay on the sidelines. Why not just hold cash, bonds, or gold? They've done better than stocks for months, and investors have pulled billions of dollars out of domestic stock funds last year. But the standard reasons for sticking with equities still make some sense. Over the long haul, stocks have produced better returns than other assets. And if you pick the right stocks, a big if to be sure, you may have spectacular results. In practice, though, investing in stocks today demand a higher level of confidence and experience that many people now possess. It takes focus and discipline to sort through the numbers when analyzing stocks to invest in. I'm pleased to be speaking today with John Sullivan, Senior Research Analyst for Olstein Capital Management, which manages both the Olstein All-Cap Value Fund and Strategic Opportunities Fund. Welcome, John, today.
Thanks for having me.
Founded in 1995, Olstein Capital Management follows an accounting-driven, value-oriented investing philosophy based on the premise that the price of a common stock may not reflect the true value of a company's underlying business. One of the most interesting aspects of their funds is the analysis focuses on how a company's operations generate sustainable free cash flow, how much of that cash flow is available to investors, and the level of ongoing investment required to maintain and grow free cash flow. John, first tell us about Olstein Capital Management, the investment philosophy of the firm.
Thanks for this opportunity to speak to American Portfolio Advisors. In terms of our investment approach, we look for good, financially strong companies whose prices and stocks have been, in our opinion, unfairly punished by short-term factors, examples of which include missed earnings estimates, overreaction to financial results, poor management decisions, changes in regulation, or overall negative market psychology. We look to buy companies that we believe are trading at a 30% or greater discount to our estimate of their intrinsic values. To get that discount or value, we often buy into the negativity that surrounds the company. We don't define ourselves as contrarian investors or buy companies' stock just because it falls out of favor. We buy a company because we believe the market does not recognize the value of the company based on its ability to generate future free cash flow. We follow a rigorous investment process for each and every one of our portfolio holdings since we believe that error avoidance is the best way to achieve above-average investment returns over time. We undertake a forensic analysis of each company's financial statements to determine the quality of its earnings, the success of its business strategy, the sustainability of its performance, and impact of management decisions on future cash flow. Our analysis focuses on how a company's operations generate sustainable free cash flow, what is the ongoing level of investment required to maintain or grow free cash flow, and how much of the company's free cash flow is used to enhance shareholder value. The most important thing is we look for companies with unique business models, with clean accounting and rock-solid balance sheets, so we have a high degree of confidence in projecting or modeling future cash flows. For us, excess cash flow is the lifeblood of a business and is the primary determinant of a company's intrinsic value. Companies that generate excess cash flow have the ability to increase dividend payments, repurchase shares, reduce outstanding debt, engage in strategic acquisitions, and can also withstand economic downturns without adopting short-term harmful strategies. As I mentioned before, an integral part of our investment process is the forensic analysis of a company's financial statements and public filings. Through our forensic analysis, we really understand how a company generates free cash flow, what elements are core to a company's business model, and we not only develop conviction in a company's ability to generate cash flow, we also develop a deeper understanding of why a company is down, how they are performing, what they've done wrong, and what needs to be done for the company to improve or close the valuation gap that created our buying opportunity. The Olstein All-Cap Value Fund is what we would call a core holding fund that goes across all market caps. The Strategic Opportunities Fund focuses more on small to mid-cap capitalization companies and follows a more activist approach for unlocking value.
Well, does the forensic analysis of a company's financial statement lead you towards investing in an operating turnaround at companies?
Yes, usually through the forensic analysis, we make a determination as to what a company needs to do to increase shareholder value. For the small to mid-sized companies in the Strategic Opportunities Fund, the questions we usually ask are, has a company outgrown the skill set of the existing management team? Are management growth projections realistic, or is management trying to satisfy Wall Street's demand for constant growth, or should the company sell off underperforming or underutilized assets?
When it comes to activist situations, do you find better opportunities in small or mid-cap companies rather than the large-cap companies?
Sure. I think opportunities present themselves across all market capitalization ranges, but it's a little easier with smaller companies because they tend to have less complicated business models, and they usually have a single owner or founding family that has a large percent of their net worth tied up in the company, and they're therefore more apt to listen, especially when the company's stock is under a tremendous amount of pressure. It's also easier to accumulate a significant minority position in small to mid-sized companies and communicate with management in a clear, decisive way. Many of our recommendations can also be acted upon more quickly by small to mid-sized companies, which tend to close the valuation gap more quickly. We buy a company after it's met our strict criteria. We buy stocks based on discounts, and that's how we build a portfolio. We build it on a stock-by-stock basis. We don't buy things and set a criteria and say, hey, this is what we want to own. It's more along the lines of what values we're finding. We control the weightings in the portfolio according to the discounts. Right now, the all-cap value fund currently has about 75 names, while the Strategic Opportunities Fund currently has about 40 names. But the number of holdings will go up and down depending on what types of opportunities and what types of values we're finding.
John, tell us about your sell process and what triggers a stock to be sold out of the portfolio.
Sure. First, I think we should discuss a few things regarding our approach to portfolio risk management. Number one is our ongoing due diligence. We constantly monitor our portfolio, focusing on the cash flows, financial statements, and intrinsic values. The numbers in our financial reports tell us what management is doing, and we care much less about what management is saying. While we seek to avoid financial risk by monitoring the company's capital structure and debt levels, we also limit our exposure to companies with business models that rely on leverage to generate greater revenues. We also consider the concentration within our portfolio that we're willing to take. We manage the risk through our size of position and also the size of position we would take based on our discount. I think that the key is that every stock we buy has a valuation, and if we feel it is approaching our value, we will decrease the position accordingly. Unless something changes or we see different prospects going forward that should cause us to revalue the company higher, we manage our positions in this manner. If we don't like what management is doing and we feel the company is on the wrong track or that we made a mistake in our investment thesis, we'll also exit a position immediately.
John, I thank you very much for coming in today and sharing your insights with us. I appreciate it.
My pleasure. It's been great to be here.
Thanks.